Working capital for marketing agencies. What is it? How do you calculate it? Why do you need it? And how do you get it? What's up, everybody? My name is Chris Hervochon. The website is betterwaycpa.com, and let's jump into it. So working capital is a measure of a company's liquidity, operational efficiency, and its short-term financial health. Keyword there being financial health, and then also short-term. So two keywords: short-term, financial health. Very important. This is a definition per Investopedia. It is going to be linked in the slides, which I will share in the show notes. So I'm not going to read this to you, but it's going to be there for your future reference. So how do we calculate working capital? Well, working capital is current assets minus current liabilities. Examples of current assets are cash, accounts receivable, or AR, inventory. If you're a marketing agency, inventory is not really a thing, right? You're a service-based business. You're generally not going to have inventory. Marketable securities. So if you, in your business, are taking cash and investing it in stocks, bonds, anything that you can sell short-term, so relatively short, in a relatively short amount of time, less than a year, and convert that to cash, that's going to be a marketable security. Office supplies. So things in your business that you're using that are going to be used up quickly: pens, paper, pencils, stuff like that, if you have it. And prepaid expenses. The best example of that for a marketing agency is going to be prepaid software. If you go and buy a subscription to HubSpot and you pay upfront for a year-long subscription, that's a prepaid expense. So that's something that's going to go on the balance sheet that you're going to use over the course of the year that you've already paid for. So it's an asset for that year until that subscription runs up, and then you've got to re-up it. And current liabilities. So that's the other side of the equation. Accounts payable. So these are bills that come into your agency that you need to then pay at some later date. That's going to be short-term, generally less than a year again. Taxes payable. So payroll tax, income tax, state income tax, things like that. Payroll payable. So let's just say you've got an employee who is paid semi-monthly, so twice a month. They're paid on the 15th and the last day. As they do their work, you are accruing an expense. So as they're working in your business, you now owe them salaries and wages, and you've got to pay them at some point in the future. Well, you've accrued that expense. It is payable. It's due from your agency. You've got to pay it. So that is a liability until you pay it, and then that cycle kind of starts over again. You're basically always going to have a liability if you're an accrual-based business and you've got employees. So, because generally what we see is the payroll period doesn't necessarily match up with the paycheck period. So the payroll period for the check that you're going to cut on the 15th, well, that pay period might end on, the 8th. So there's that week lag. So that's how that cycle keeps continuing. Upcoming media spend. So if you've got clients who you are running media for, who you're going to bill, say, at the end of the month, and you've got to run media for them all month, and you are going to have that expense, you're going to pay it, and then you're going to get reimbursed by the client later. That's going to be a liability. You are liable for paying for that media spend through the course of the month. Accrued expenses. These are things that have occurred in the business that you have not yet paid for or been billed for. Client deposits. If a client makes a deposit with you, you owe them services for that deposit. That deposit is a liability. So they could demand that you pay it back. You might not perform the services for whatever reason. You're going to owe that back to the client. And credit card payments. So if you run up some credit card debt, paying for expenses in the business, the payment's going to be due for that credit card at some point, right? Generally every month. So that is a liability that you have to plan for in your business. Two ways to show working capital. So one is, this is a nominal amount. So it's current assets minus current liabilities, dollar figures. And we're just subtracting current liabilities from current assets. We want working capital to be positive, obviously. But the other way to show this is as a ratio. So current assets divided by current liabilities. In the agencies that I work with, they're generally going to be between 1 and 10 people. I think it's about 75% of all marketing agencies are between 3 and 10 people. They're generally smaller businesses. upwards of maybe a couple $1 million in revenue. And so I think showing this as a nominal type measure is probably more impactful than showing it as a percentage, because what's a percentage mean really? We've got to put context around that percentage. I think, when we're giving a strict dollar amount, like, hey, your working capital is $10,000 in the red right now. I think that has a little bit more impact for the smaller size agencies, but that's just my opinion. Certainly you can show it both ways. Why do you need working capital? Most importantly, liquidity and financial health. If working capital is negative, that means you've got more liabilities than you have assets. That means you're going to have a hard time paying for those liabilities. Those liabilities are going to come due. You've got to pay for them at some point, if not now. And you're going to have a hard time with that given your current financial situation. Now, if working capital is positive, you've got a little leeway. So you can start to scale your business, which is the second point, scalability of the business. If your working capital is positive enough, then you can start thinking about, well, do I need to hire people? Well, can I start making investments in, efficiency initiatives or software, new software that I want in my business to make me more efficient or more profitable? Or can I start investing in R&D? It allows you to scale the business if you've got the appropriate amount of working capital. Liquidity and financial health, and just make sure that you're going to stay in business. So if you've watched any of my videos that pertain to the Wayfinder and the 4 pillars of business strategy, and we talk about financial strategy, managing working capital efficiently is one of the ways that we address financial strategy. Okay, that's one of the tactics. So how do you get working capital? And again, this goes back to that second pillar of financial strategy. The first thing you can do is you can increase sales. But it's only good to increase sales if that revenue is actually going to fall to the bottom line and if it's going to turn into cash. So if you have $1 of revenue, but the expenses to generate that $1 of revenue are also $1, then you've got zero margin there. There's nothing that's going to fall to the bottom line, and your cash impact is going to be zero. What we want to do is we want to be able to increase the sales and keep the margin steady and or increase it. So you'll see the third bullet point there is increase margins. So when we are increasing margins for every extra dollar of revenue that we have, we are increasing the amount that is likely or will fall to the bottom line. Then we've got to turn that into cash. So that gets into our accounts receivable processes, making sure that the accounts receivable collection process is faster and also more efficient. So sometimes you'll offer a discount to a client for paying early. Sometimes you will have to send that invoice to collections, which means you're only going to collect a fraction of the revenue that you actually generated when you generated it. Sometimes you're going to have a client who's going to pay by credit card that's going to roughly result in 3% less in cash collected than you would if you got paid in cash, or if you got a check in the mail or wire transfer or something like that. And so these are all things that we need to be mindful of when we increase sales. We want to make sure that it also turns into cash. The second bullet point here, borrow long, not short, and only for a certain benefit. So if we think about this equation right here, it's all current, okay? So when we talk about borrowing long, that means long term. So loans that are going to mature in more than 1 year and only for a certain benefit. So that means if I go and borrow this money, what I'm going to do with the cash is I am going to turn it into a certain benefit. I'm going to turn it into revenue. I am absolutely positively sure that I'm going to turn it into revenue, and I'm pretty sure, if not almost certain, that I'm going to turn that into cash too. We just talked about that in the first bullet point, right? So by borrowing long, we do not increase that right side of the equation. We don't increase that current liability side because it's a long-term liability. But we do increase the left side of that equation, which is the current assets, which is cash. Cash is one of the current assets. So if we increase current assets, we do not increase current liabilities. What we have done is we have increased our amount of working capital that we have. Now, we have to make sure that there's a certain benefit, because at some point that long-term payable is going to turn into a short-term payable, and we need to be able to make sure that we're going to pay it back. Same applies to subscriptions and software licenses. This is a really good example, especially for marketing agencies. So let's just say that you provide website maintenance and or build websites for your clients. And let's just say you go get a WP Engine subscription and you buy it for 3 years. Well, that cash outlay is going to come at the front because you're going to get that discount. That's why they give it to you. That's why they give you the discounts, so that they can get the cash up front. And what that is doing is increasing their working capital. But you've got it for 3 years. You're going to have a benefit for 3 years. You're going to have that prepaid expense that you can use over 3 years. But is that really the most efficient way to use your cash? So if you could have used that cash instead to pay down one of your current liabilities, and that would have provided you the largest benefit to your working capital, then that's what you should explore. You shouldn't necessarily explore these long-term type subscriptions if it's going to suck up cash that you need in the immediate short term, and if it's not going to be the most efficient use of cash. So in other words, here's a good example. If you're going to pay down a credit card as opposed to buying that long-term license, that might be a more efficient use of your cash, because those credit cards are going to come with very heavy interest. That amount is going to be due every single month. And so that's one thing that we should think about when we're talking about increasing working capital. Taking advantage of vendor discounts, essentially what this does is it decreases that account payable. So if we're going to take advantage of a discount, that $100 account payable, maybe that now turns into $97. That's going to increase the nominal split. So current assets stay the same, and they're going to decrease less than we thought that they were, and current liabilities will decrease. Cut expenses and make sure all expenses are necessary. That gets back to making sure that every dollar of revenue is going to fall to the bottom line and also turn into cash. And that gets back to the point I was just making before about being efficient with our use of working capital. So a couple final thoughts, but working capital is an important financial metric to pay attention to. This is something that you should be tracking on a consistent basis. You should know where you are. You should make sure that it's positive. Working capital will allow you to scale. I got a really good question from a client actually yesterday who didn't word the question exactly like this, but the basis of the question was, when do I know that I've got enough money in the bank to go and be able to hire somebody, to be able to hire, a consultant? Working capital will allow you to do that. If you know what your working capital is, you can start to, and you know what that expense is going to be, or you know how much that next employee is going to be, you can start to figure out how much working capital you need, what's appropriate, and how you can best manage that. And then just to play devil's advocate here, but on the flip side, too much working capital is a bad thing. It means that you're not efficiently using the current assets in your business to generate the biggest benefit for your business or for you as an owner of the business. A good example of that is if you're holding tons and tons of cash, you're not going to really use it. You don't really need it. You don't need to go hire more employees. You don't need to go buy new software. You've got a ton of cash sitting in the business. And let's just say that you don't have, material payables. Well, you should be doing something with that cash. Maybe you should be investing it in CDs. Maybe you should be investing it in marketable securities, something to generate an additional benefit from that working capital. Resources for today, the slides are going to be posted in the show notes, like I mentioned earlier. Link to this YouTube video will be there. The marketing agency sample Wayfinder, where I talk about the 4 pillars of business strategy. And it also goes through kind of this financial strategy piece that we're talking about here. That's out there. The Investopedia link for working capital out there as well. There's a YouTube video that I did some time ago about the Altman Z-score, which is also a measure of financial health for your business, but that's linked out here as well. That's something that I think is a good companion video to this video, so I would recommend you go see that. Quora, I talked about quite frequently on Quora, actually. I talk about how you should have sufficient working capital for your business and the adverse effects of not having that working capital. So this is a link to one of those posts. And then finally, there's a CFA Institute article here, which talks about working capital management, which I think is really good. So let's connect. Chris@BetterWayCPA.com, 843-608-0298 is the phone number. You can find me on Facebook, LinkedIn, Twitter, Quora, Pinterest, and Instagram. So you can find me everywhere. That's it for me today. I appreciate you watching, and I will see you next time.